Okay, so welcome everyone. So in today's session, we are looking at Learning Unit 7, which talks about the capital gains tax. So I'm going to just recap some key things before we start the questions that we're going to discuss in class today. So the questions we're going to look at, so you can get that ready as well, is we're going to look at question 7.2. And then 7.3 in your tax workbooks, and then we're going to discuss how to do each of the calculations. Okay, so with capital gains tax, the main or the important thing to remember is that you have to work out if there's any capital gain on the disposal of an asset. Now, normally what triggers the disposal is when you get rid of an asset, so whether it's voluntary or involuntary. So involuntary means it was scrapped, hit by lightning, in an accident, so it's not something that you preempted, it's life that happened. Whereas voluntary, you decide you want to sell it. Now, when we dispose of an asset, there's two things we need to look at. The first thing you need to look at is, do we have any recoupment or scrapping allowance? Now, that will be determined based on the fact, were you allowed to get a wear and tear allowance or any other capital allowance for that asset? As soon as you were allowed to claim wear or tear or capital allowance, which is the Section 12C or the Section 13 or Section 12E allowances. If you were allowed to claim that, you would generally have a recoupment, and the recoupment would normally be whatever you have claimed as a deduction previously. Now you have to look at what is the proceeds that you get for that asset, and if it is less than the original cost, we can only recover up to the proceeds value. If the proceeds is more than our cost amount, you cap it at the cost, because the cost was the amount that you used to work out those deductions. So you would not have been able to claim more than the original cost. So therefore, when you do the recoupment, you limit it at the original cost value. And then the difference between what the tax value, so the carrying amount of that asset is on the day of sale, less the proceeds or the cost, depending on which one was the lower, you would then work out the recoupment amount. But then the next step is to work out now the capital gains or the capital loss. Then we take the proceeds, so the value that you sell it for, and you reduce it with any amount that you are taxed on as a recoupment. Okay, and then you adjust your base cost, which is your original cost less any amount that was used in the recoupment calculation, to work out what is the new base cost, to work out then what is the capital gain. Now, when we do capital gains calculations, you have to do each and every gain or loss for every asset sold during the year. And then at the end of the year, you total them all together. We call that aggregated capital gain or capital loss. And then you only apply the annual inclusion rate of 80% for your company. If we've got a loss, we roll it forward to the following year. We call it assessed capital loss. We do not use it in the current year taxable income calculation. We roll it over to a future period, and then if we make a gain in the future, we reduce that gain with that capital loss before we then work out how much will be taxed. So what they can do in your question is they can state in the question, yeah, the assets we sold, and then as a line item right at the bottom, they can tell you, in the prior year, you made an assessed capital loss of, for example, 100,000. Then you need to remove that from your aggregated capital gain before you go work out what will the taxable capital gain be. Okay. Now for this, let me just quickly. Your learning objectives specifically for your capital gains is you need to know how to deal with it from a perspective of your resident versus a non-resident. Now, the main difference between the two is, for a resident, you are taxed on your assets worldwide. So it doesn't matter if that asset is in South Africa or overseas, you are taxed on the capital gain you make, irrespective of where it's located. Whereas a non-resident, you are only taxed on assets in South Africa. So that's normally buildings or movable items that is located in South Africa that get sold here, will then be taxed for non-residents. And then they say you need to be able to determine your capital gains tax that is applicable, calculate the proceeds, then the base cost of pre-valuation date asset. So that is an asset I've acquired prior to 1 October 2001. Now they've made it easier for you guys. They will give you the market value and they will give you the time apportionment based cost amount. You do not have to calculate those two. But when you have a pre-valuation date value, you have three methods that you can apply. First one is the market value. Second one is the time apportionment based cost. And the third one is 20% of the proceeds, less any expenses after 1 October 2001. And as the taxpayer, you will generally use the higher one of the three to reduce your capital gain in the future. So normally it is the market value, but if you do not have the market value or the time apportionment based cost, then you would have to apply the proceeds amount. So you have to look at what value you have available. Then they say you should be able to calculate the aggregated and net capital gain. So aggregated capital gain is all the gains, and net capital gain is the aggregated capital gain less any assessed capital losses that was carried forward. And the inclusion rate for your companies is 80%, but if they give you a sole proprietor, which is an individual, it's 40%. Okay. And for the individual, you also get an additional annual inclusion deduction of 40,000. Okay, so we've discussed the main two things that you have to look out for when you have a sale. The first thing is recoupment, that is included in your gross income. And then after you've done the recoupment, then you only do the capital gain portion, which is shown separately in your calculation. So when we look at the tax framework again, our taxable capital gain is right after we've done the capital allowances deduction. You would have that line item. But remember, it's only the taxable portion, which means it's 80% of your net capital gain that you will deduct. And 40% of it's an individual. And it's just before we do that subtotal that we work out the 10% for the donations deduction. Okay, so that's where you will find the capital gains. Now, you can do it as a separate calculation in your test, or you can just create an extra column, and as you do the calculations, work out the gain or loss with the recoupments to keep track of the information. Okay, so you can decide how you want to do it. Now, just to recap, how do I actually work out my capital gain? How do you think we work it out again? What was the steps? How do I know if I made a gain or loss on? Okay, so how do we do the gain again? How do we work it out? What figures do you need to work out a capital gain? We're busy with learning unit 7. Okay, so the first thing you use is the proceeds. Okay, so how much money do I get in? So it can either be money that someone's paid me, it can be insurance money that I receive if it's scrapped. Okay, the second thing is the base cost. Now that will be determined based on when you acquired that asset. If it is before 1 October 2001, then you do the pre-valuation date cost, and then you add any costs subsequent to that date onto that value to work out your base cost. If it is something that I've acquired in recent years, then I add any cost that I acquired for that asset to bring it to its current location and condition for the use that it was intended. So let's say, for example, I buy a machine from overseas, then the import duties I'm allowed to include, as well as any transportation costs into that asset, as well as any legal fees to get it registered, whatever the case may be. So those costs I can then capitalize in my base cost, and then the difference between your proceeds and your base cost, that will be your capital gain or loss. Now, like I said, you work it out for each and every asset, and then you go add all of those values together to get an aggregated capital gain. So that's where overall I've made a gain, or aggregated capital loss, overall I made a loss when I disposed of the assets. Now, if it is a capital gain, then I reduce that amount with any aggregated capital losses carried forward from prior years to work out the net capital gain. Okay, and that value, we apply the 80%, which is our inclusion rate, to work out the taxable portion, which is included in my taxable income calc. If I have a loss on the other hand, then I add the prior year losses and increase the loss that I carry over to next year. Okay, so that's the difference between the two. And then you don't include that loss amount in your taxable income calculation. Okay, so let me quickly put it. Just going to put it on the board for you. I have to record the session for whoever has the Diwali today. So that's why I'm sitting here. And I can't get the projector to work today. So, but I've put the slides for you on VC. Okay, so let's just recap quickly. So you start with, let's say we've got asset 1, we've got asset 2, asset 3. Okay, now let's say for the first asset you made a capital gain of 10,000 Rand. For asset 2 we had a capital loss of 5,000 Rand. And then asset 3 we've got a capital gain again. And then say that is 20,000. So what it means with aggregated is we add all of them together. So all of the gains, all of the losses are added together. So based on the values we've got here, we made an overall gain of 25,000. But now I also have to go look at, do we have any assessed capital losses? So this is where this amount there was not a gain but a loss. Then I carry it over to the next year. Then I stop there. I don't do anything further. Okay, but let's say I've had an assessed loss in the prior year of 15,000. Then I reduce the gain I made in this year with that assessed loss, and then this is my net capital gain.
Will the assessed loss be mentioned in the question?
Yes, they will mention it as a separate line item. So they normally bring it in as an additional point right at the bottom. They will normally discuss this. And then only this portion, we apply the 80%, which means 8,000 it goes into my taxable income. Okay, so only this will be taxed as part of my tax calculation. Now, if I had a loss, let's quickly change this up. Let's say this was actually, let's make this was 25,000. So that means I made a profit of 5. But now I've got 15,000, which is more than the 5. Then I still have a loss here. So then I've got a net loss. But then I don't apply this 80%. I carry this forward to the next tax period. So any losses in prior years, you can only offset it against any capital profits that you make in the future. Okay. So that is the difference between the two. Yes.
No, why 80%?
That is the inclusion rate as per the Act. So for a company is 80%, for an individual will be 40%. Okay, are you guys all right for that? Okay, so when we do the proceeds, just remember the main thing is, do I need to reduce that proceeds value with a recoupment amount? Now, based on all the questions they've given to you, you will see a recoupment in there where you have to reduce that proceeds in the base cost with. They will test it that way. Because we are testing two things in one question. Okay, so make sure when we go through the questions that you understand those two concepts. Okay, then disposals. There are certain things that if it happens, it is deemed as if you dispose of the asset. One of it is if you change your resident status. So if I immigrate, it is deemed that I have disposed of all my assets in South Africa at market value. Okay, at that date. Or if I become a resident. If I, for example, have trading stock and now I had a capital asset and now I make a trading stock, it is deemed as if I've disposed of that asset when I move it to trading stock at the market value. And then anything I use for personal use. So if a business owner takes, for example, stock for his own personal use, for tax purposes, it is deemed as if we've disposed of it at that date at the market value. Okay, and then any reduction in debt. So I owe someone money and they say it's okay, you can write it off. Any reduction in debt is also viewed as if I've disposed of an asset. Okay, so that's, for example, a loan would be viewed as a capital gain because you would have the proceeds, but you would not have a base cost for it. If I donate an asset, it is also seen as a disposal. Now you have to look at what type of entity it is. So normally it is at market value, but for the PBOs, we apply the cost amount. And then we said there's 3 base costs for pre-valuation date, which is 1 October 2001. Make sure you understand how to do that calculation. They will give you the market value. They will give you the time apportionment base cost. Just remember with the 20% times the proceeds, that proceeds is what you sell it for, less any cost incurred after 1 October 2001 is how you work out that value and you apply 20%. Now, if you've got more than one of those amounts, you can apply the higher for your calculation. If it's an asset that you've acquired after 1 October 2001, the actual cost is what your base cost would be. Okay, now what do you include as expenses in that value when you do that value? You look at the purchase price, any valuation cost that you had to incur, any cost that you incurred to acquire or dispose of an asset, any legal fees that you need to inquire, any improvements or enhancements. So let's say you bought a building and during the years you've improved it, you add that to your base cost. Any borrowings that it excludes borrowing. So if I borrowed money against that property, it excludes that. The reason for that is we do not want to disadvantage someone that purchased it on cash. And then any repairs and maintenance is also excluded because that is a normal deduction. Okay, it's not capital in nature. With section 13 specifically, your buildings, your manufacturing buildings, you generally get a 5% capital allowance on those buildings. Now, what happens if I dispose of that factory, whether it involuntary, so something happened to that building and I had to get rid of it. So let's say it burned down, then it's deemed you got rid of it. And now I acquire a new building. Then I can defer that recoupment over the same period as the original allowance write-off. So in that scenario would be 5%. That is the only deferral that you guys need to be aware of for recoupments. There are other ones, but this is the only one they will test. Okay, so the one for manufacturing buildings, if you have to dispose of it, let's say it burns down, so it's involuntary, whatever recoupment you make on that building, you spread it over the original write-off period. So for buildings, it's 5%, so it would be over 20 years. Okay, so that is the rule. Just remember that. We are going to look at an example like this in one of the questions today, so you can make a note there as well. Okay, before we start with the questions, do you guys have any questions on capital gains specifically?